Earnings week continues, and today our focus is on Procter Gamble that just reported before the market open, and we can see they are currently down 3.5% in the pre-market, and today we want to understand why that is and do we consider it undervalued to continue to add. Now, in terms of the headlines, one thing that we do like to see is that they did beat on the earnings. However, we have noted that their quarterly sales did come under what analysts were targeting. Now, one thing that has come from their highlighted points, which is always great to see, the company's volume for the first time in more than 2 years has increased, meaning they are shifting more products, always a good sign. Now, when we get to the actual numbers, what we can in fact see is that on the earnings per share, it was a nice marginal beat, 1.4 versus the 1.37 expected. But we do know they did come under in terms of the revenue by around 200 million, 20.53 billion versus the 20.74 that the market was hoping to see. Now, in terms of their net income, well, it came in around 3.14 billion for the quarter, which is down from the same quarter in 2023, where they did report 3.38 billion. In terms of the sales itself, now look, net sales of 20.53 billion, it was flat when you do compare it to a year ago today. And one thing that we always do like to talk about on this channel is that at a bare minimum, whether that is a company sales, whether that's your own dividends, your own salary, you want to be increasing it at a minimum of 4% year on year just to keep up in line with inflation. Otherwise, you are losing your purchasing power, and in real terms, it is a decrease, a pay cut. And in this case, we can in fact see for Procter & Gamble, when we compare the sales to a year ago, whilst numerically it does look flat at 0% movement, in reality, when we factor in inflation, it's around a negative 4% drop. On top of that, when we're looking at their 2025 earnings and their estimates, they do believe that they will have around 2 to 4% growth in terms of the revenue and EPS of around 691 to 705. Now, 2 to 4% growth is not the greatest. Ideally, we want to see, as we just mentioned, at the upper end of the 4%, something that we will need to factor in. Now, going back to the company, as we said, it is down in the pre-market, and over the last 12 months, it is up around 9%. Over the last 10 years, it is up around 112%, not too far off the S&P itself over the same period, but we will do a comparison later. And before the drop, it was pretty much sitting at a 52-week high. And right now in the market, we get one buy, that is from Wall Street, and they double hold from Seeking Alpha and Quant. In terms of the forward P, although when the market opens, it will come down slightly, sitting at 25.93. S&P right now around 23, and the yield on a forward-looking basis sitting at 2.37. Now let's look under the hood, let's see what the metrics are saying and whether or not, as a general rule of thumb, it is a high-quality company based on the numbers. Dividend safety then, 99, very safe, the highest score obtainable, always love to see that. And in fact, this year they did increase that dividend at 7%. We like to see that mid to high single digit. As we said, above inflation, always a very good sign. In terms of dividend safety, well, it was reaffirmed May this year, effectively meaning a dividend cut is highly unlikely. Now, a lot of people have started to say how a recession is inbound at the end of this year, 2025. Well, effectively, 07-09, when we had the last Great Recession, they in fact increased the dividend. They had negative 9% recession sales. Bear in mind, the S&P average was sitting at negative 12, so not far off, but they did significantly outperform negative 36, with the S&P itself negative 55. As we already mentioned, a nice increase to the dividend this year, and over the last 5 and the last 20 years, in general, they do typically and consistently increase it by mid to high single digit. I do quite like to see that, and they are in fact a dividend king, 50 plus years of consecutive increases, and they've been paying a dividend for the last 133 years without a reduction. Always great to see. Now, on this channel, we do take some focus onto dividend yield theory, which states a company is undervalued when the current yield sits above the 5-year average. Right now at 2.37, we do believe this will go up higher when the market opens, in line with the 5-year average or thereabouts, so reasonable valuation, and we could argue the same on the 5-year average against the current forward PE. So reasonable valuation, although we do see the consumer staples as a whole of the sector much lower at 17.5, but worth remembering we're not looking at any one of these models in isolation. We will conclude when we come to the valuation part. We then focus on the free cash flow payout, as always below 70% for consumer staples industry specific. My blanket rule, 60% or lower. What we do note over the last 10 years, bar 2017, it has been below 70%, 63 over the last two, 60 expected over the next 12 months. So always a great sign, especially when you are considering that they should be able to continue to increase that dividend at the mid to high single digit mark. Free cash flow as well. I want to have companies that continually increase and consistently their free cash flow per share, which is something we can see not quite doubled over the last 10 years, but moving in the right trajectory. Over the next 12 months as well, we can see that expected to continue the upward trend. We then look at the sales growth. Now, 2014 to 2016, they were negative, but since then, it has looked okay. Understand, we want to see 3 to 7%, and they are pretty much trying to keep it up in line with inflation at a bare minimum. Just understand this, not for the margin of safety that we'll come onto, but just in general, when you are basing your expectations, this isn't a tech company, or this isn't a company that will increase their top line at double-digit rates. It will be something that will chug along with inflation, or ideally at that level as a minimum. And we can clearly see that with the top line sales. In terms of share outstanding, well, they do return some excess cash through those share buybacks, not very consistent though, but overall they have bought back a nice number of shares over the period. Always a nice bonus for investors that we do receive as well. In conjunction with that, a nice starting yield with nice dividend growth consistently. ROIC, one of my favorite metrics, 10% or more, or 12 for industry-specific consumer staples. Give us faith, management are able to effectively allocate their capital, 12% to 21 over the last 10 years. Great to see, not only at a very nice level in 2014, but it has been increasing over the longer term. Low 20s over the last 3 years, 24% over the last 12 months. Always a great sign, and I love to see that, and one of those metrics I really focus on when considering adding companies into the portfolio. We then move on to the margins. First one is the operating, very strong sign of operating efficiency, not only above the 16%, but increasing from 19 to 23, always a great sign, and one way to identify a high quality company. Free cash flow margin as well, well above the minimum 7%, 18 over the last 2 years, 20 on a trailing 12-month basis, so a very good performance when solely looking at the margins. And the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, below 4 for consumer staples, and the numbers below, as always, show us the number of years it would take the company to pay off all of that debt net of cash on hand. Now, why we focus in on this metric as a very important one alongside the ROIC, it correlates not just to the dividend safety that we have as 99 very safe, but also the balance sheet strength that we will come on to shortly as well. 1.39 in 23, expected to go lower over the next 12 months. So it clearly shows us that Procter Gamble not only has a very safe score that we can now back it up, but also their balance sheet does look to be strong and healthy. Now, one thing we also like to look at here is the movement in insiders as well as institutions. 0.17% insider ownership, 97 million worth of sales over the last year. But what we note in the more recent quarter, no movement by insiders, but pretty much it is quite a constant thing quarter on quarter for insiders to sell, so no surprises there. And as we always say on this channel, insider selling isn't exactly a bearish signal. They will sell for a ton of reasons, personal, financial, as well as many others. Now, the CEO, in fact, did sell on the 20th of May, so we are talking about over 2 months ago, just under 32,000 shares, $167 for just over $5 million. Again, you can see these other sales here for transparency. We then do the same, but for the institutions, where we have 66% institutional ownership, 17 billion worth of sales, around 18 billion worth of buys, so not too dissimilar from each other over the last year. Although we can point out in quarter 2, we do note more selling than buying by the institutions, and you would have to go back quite some way around quarter 3 of 22 to see this same trend. Now, it doesn't really matter whether institutions or insiders buy or sell. You shouldn't base your investment decisions off that. Always do your own due diligence. Now, we want to highlight we have released our latest articles, one of them being for the paid subscribers, where every month we send them the undervalued companies for that particular month. If you are subscribed, you can have access to 35 different undervalued stocks for this month, and I also run through each one of these, which I hold within my own portfolio as well. And there are many other articles for those that are just purely subscribed on the free basis. basis. Next thing we like to go through is the earnings, historical performance, as well as the future. Now, as we mentioned, they did beat marginally, but what we can see historically on the earnings, they do typically tend to beat. They have a 100% track record, and just going over the next few quarters, as we mentioned, very minimal growth expected with this company, so do bear that in mind, around low to mid single digit growth. Now, if they hit their June 2025 estimate of just under 7, that will bring down the forward P to around 24.41. We then like to take a look at some gradings, the first one being the valuation, where they do get a D-, and in fact, whatever valuation method you do look at, what this is ultimately showing is that this company does trade at a fairly strong premium to others in the sector. For example, if we look at the P on a non-GAAP basis, 26, whereas the sector median at 17.14, effectively telling us we are paying 51.25% more for Procter & Gamble than the sector median as a whole. Now, let's see whether or not it is actually warranted and justified. Firstly, on the growth, well, they do get a D+. Year-on-year growth, 3.8%, with the sector median at 2.23. Forward-looking basis, just under 3%, sector around 3.53. And one thing we really like to draw your attention to is the earnings per share, just under 8%. Again, not too far off the sector as a whole, 7.94. So there we have it in terms of the growth. And the final one that we do focus on is the profitability, which looked very strong for Procter & Gamble. So what we can see, their gross profit margin at 51%, sector median at 35%, bottom line as well, 18%, very strong comparison to the sector of 4.41, and their cash from operations is obviously very, very large, 19.4 billion versus the sector at 817 million. Now, in terms of a conclusion, we do get one buy from Wall Street with a double hold. We also note a D- on the valuation with a D+ on growth and an A+ on profitability. Now, before we get to the valuation, a few things to note. The first one, we do a very quick comparison against others in the household products industry. We have CL, Colgate-Palmolive, as well as Kimberly-Clark, and a few very well-known others. Now, when we look at it on a total return, this means reinvesting those dividends as well. Procter & Gamble is right there towards the lower end of these competitors or these other companies we have in the industry at around 12%. Then when we increase it to over the last 5 years, they are actually the best performing, up 66%. And then when we expand it to over the last 10 years, they are the second best performing there, 183%. Not a bad return over the longer term. Again, just remember, it doesn't mean they will perform this over the next 10 years. It could be a lot better. It could be a lot worse. And we have Church & Dwight outperforming up 250%. Always like to do a quick comparison to the S&P as well. We do note over the last 12 months, the S&P has outperformed 19 versus 12%. Over the last 5 years, again, we do see some outperformance, although fairly marginal. And when we extend it to over the last 10 years, they have been pretty much in line, so very minimal difference between the two. As always though, let us know your thoughts if you believe over the next 5 to 10 years, or whatever your investment time horizon is, that you believe Procter & Gamble will be able to outperform. As we can see, very marginal difference over the last 10. As always, if value is provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And our intrinsic value of $179 isn't dissimilar from Wall Street's target of $178. As we can see, they believe 8% upside over the next 12 months. How we got to our intrinsic value? Well, we ran it through 3 models. We have the multiples valuation, the P of the companies we took a look at. We have the EPS of Procter & Gamble, where we get our first undervaluation signal, although you could argue very minimal given the very small price difference, and we don't look at any one of these models in isolation. We then have the dividend discount model, average growth at 6.2%. We've gone for a little bit lower to be more conservative. We get our second undervaluation signal. And then we look at the DCF model, where we have the free cash flow year on year, growth rate moving forwards at 10% per analyst targets. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to equity value, divide by the shares outstanding, and we have our third and final undervaluation score. Now, bear in mind, you can grab a copy of this model by clicking on the pinned comment below and running through your own numbers, whether it's for PG or any others. Now, with the margin of safety, as always, we start off with 10% and we execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. It doesn't actually meet that in today's episode, but it could get there with the drop it has had so far in the pre-market. So around $161, you would get a 10% MOS. In terms of 15%, you would have to wait for 152, and around 20% around 140 or towards that lower end. Now, personally, this is one that I do hold myself in the portfolio, but it isn't one that I will be adding. It is right there at the 52-week range, and I would be wanting to see at least a 20% margin of safety before continuing to add to the portfolio. As always though, do let me know your thoughts below whether or not this is one you're considering to add, maybe in fact considering to sell, or purely on the watch list waiting for a lower MOS. Don't forget to join the free weekly newsletter as well, have a read. There are a lot of undervalued stocks that we do believe that should be taken advantage in this market, and if you want any of our weekly buys or sells, do come and join us in the Patreon. As always, we'll see you all on the next one.